All right, how y'all doing today? Welcome back to my channel, the Cheryl Hubbard Show. Glad to see you, glad you can join me, glad you can be here. So today, just want to go over a little bit more of accounting, just a little accounting tutorial, and maybe talk a little bit about business and branding. So talk a little bit about accounting, just a little recap, or a little, I guess I would say a recap, or review, recap, whatever you want to call it. So first, let's start out with what is accounting? Let's start out with what is accounting. Okay, accounting is a system that measures business transactions, and those transactions are made up into reports for the decision makers. So whether it is like decision makers, well, whether these decision makers are internal or outside decision makers. So internal decision makers would be your managers. So managers need that information from these accounting books, the accounting transactions, so they can make informed decisions. Your outside decision makers, your creditors, your auditors, your debtors, your creditors, your auditors, the SEC, Security and Exchange Commission, individuals, other businesses. We all need accounting information. We might want accounting information from other companies so we can see how well those other companies are doing. Investors. So whatever you are an investor and you want to invest in another business, you want to know how the business is doing. Let me look at their books. I want to see what their accounts receivables look like, what their accounts payables look like, what are their debts, how many people do they owe, how much do they owe, are they on the verge of bankruptcy? So those are the things that we want to know. So those are the people that, need accounting information. Those are the users of accounting information. So accounting is a system, information system. All that accounting information within an organization is gathered, made into reports, and passed on to the decision makers so they can look at those books and those records and see, hey, say for instance you're a company, you want to build another wing on your company, you want to hire more employees, you want to diversify, you want to expand your product line, whatever you want to do, you want to make sure your books are in order and accurate, and you want to make sure you have enough net income coming in to, when you're going to make those decisions. So you say, hey, you want to make sure you're making the right decision. You don't want to say, hey, say for instance you're a company and you've been in business 2 years, 3 years, 4, 5 years, or how many years you've been in business, and you decide you want to purchase some land so you can expand your business. You want to expand your company. You want to see. You want to look at your net income. You want to see. You want to look at your accounting information. You want to look at your accounting system. Within your organization to say how well are we doing this year? How did we do well enough where we can go ahead and expand our product line this year? We can hire more employees. We want to purchase more machinery, more merchandise, more inventory, office supplies, or whatever. Whatever decisions you want to make within your company, you're going to want to look at your accounting books. And you can also outsource. So sometimes companies may have other companies that come in, and they may come in and, do their accounting books. And they do their accounting books and then see, take it from there. And that way they'll let them know, owners of the company, the managers of the company, the company that you outsource with will let you know how you are doing. So let's move on next to, let's see what we have next. So we have, like I said, accounting. Accounting is a system that measures business activities, processes that information into reports, and communicates the results to decision makers. So just like any other business, any business that you go in, you're going to need an information system. I mean, you can be running a law firm. You're running even McDonald's, Wendy's, fast food chains. My company, Shirley Cosmetics. Like I said, law firms. cosmetic companies, whatever business you are running, you're definitely going to need an information system because you want to bring that information in, form it into whatever kind of system you want, and then that's how you're going to use that information to help build your company, help strengthen your company. So information is very important. So you have to bring in the right information. You want to bring in those trends. You want to constantly do research. You want to look at all the trends in the market so you can enhance your company. Like I said, you might want to diversify. You might want to hire more employees, more supplies, more machinery. You might need, depending on what type of business you're running, you might need big mainframes. You might need many computers. You might not need those. It depending on what you need. It depending on, like I said, the company that you're running. So, and then we have the accounting cycle. The accounting cycle is a process by which companies produce their financial statements for a specific period of time. So the accounting cycle, you want to have those books. You want to have those books ready at a particular time. So in the beginning, you might have a certain amount of money in the company, and then in your company, and then by the end of the accounting cycle, in other words, you invest a certain amount of money to start your company. Say, for instance, you invested $100,000. I would debit cash $100,000 because that would be starting out with my business bank account. Say, for instance, it's Shirley Cosmetics LLC business bank account $100,000. I want to debit cash $100,000, and I want to credit owner's equity. And then that would be the beginning. See, you always have two transactions. So Shirley Cosmetics. I want to invest $100,000. I want to debit my business bank account, business cash bank account. I guess I would say $100,000. Credit owner's equity $100,000. So, like I said, this would be the beginning of the accounting cycle. So, if I invest money in my business, I have $100,000 worth of equity in my business. This would be the beginning of my accounting cycle. So as I move through the accounting cycle, so as I move through the accounting cycle within my business, I'll be making several different transactions. I might want to buy some supplies. I might purchase some land. I might purchase another building. I might have to pay my employees. I would say payables, salaries payable. Well, whatever transactions that I had within my business, and then I also would probably would have some receivables and some payables. So all your receivables will count as an asset too. Your receivables are assets because there's money that is expected to come into the company. So these will be all considered transactions. When you purchase supplies, that's going to be a transaction. You're purchasing land. You're selling land, purchasing land, paying for purchasing a building. So you can, operate your business. You have your salaries payable. You have to pay your employees. Accounts receivable. That means you have money coming in. So that's considered an asset. So all of these would be considered transactions that would be going into the accounting cycle. So by the time, you reach the end of the accounting cycle, then you'll see, how much your company is worth, how much you have your net income. So you have your revenues minus expenses. What revenues do you have coming into your company? In other words, you have a company, barbershop, you have a hair salon, you're constantly doing hair, cutting hair, permanent hair in your salon. So all that is service revenue. So add all that up, you add all your revenues up, minus your expenses, that will give you your net income for your revenue, minus expenses, will equal my net income. revenue minus expenses will give me my net income. So whatever transactions come from all your revenues and then minus your expenses. So whatever transactions come out of that and give you net income, all of this stuff will be probably done by your accounting department. You might have accounting department, or you can do it in-house. Like I said, you can also outsource. So by the end of the accounting cycle, all your reports should be drawn up from all the transactions that have been that were made during the accounting cycle. So, and then you have your balance sheet. Assets equals liabilities plus owner's equity. So you have assets equals liabilities plus owner's equity. Assets equals liabilities plus owner's equity. For whatever assets you have in your business, then you want to take your liabilities. Your assets should equal your liabilities minus your owner's equity. Your liabilities plus your owner's equity. Assets equal liabilities plus owner's equity. So, like I said, all this will be done more than likely by your accounting department. You can do it in-house, or you can outsource. So, let me look at some of the trends in accounting. Let's look at some of the trends in accounting. Okay, so accounting trends. So, like I said, you can outsource, have another company or individual do your accounting books. You probably have like a CPA, certified public accountant, certified public accountant doing your books. That he or she can be a person working within an organization, or if you want to hire an outside firm, you want to outsource outside firm to do your accounting books, that's fine. So, and one of the trends, run your business in the cloud. Access and manage your books from your computer, laptop, tablet, or smartphone anytime you choose. A cloud accounting solution in your pocket. QuickBooks mobile app. With QuickBooks mobile app, you can keep an eye on your cash flow, use time tracking, process payments, all from your phone. Upload receipts from anywhere for easy expense tracking. So now, accounting it's been digital. So in other words, you can work right from your mobile phone. So that's one of the trends on mobile phone. Keeping a track of your accounts receivables, your accounts payables, your interest payables, your inventory, your office supplies, whatever accounts you have in your business. Like I said before previously, depending on the type of business that you're running, that will determine the accounts that you have. But more than likely, every company probably will have accounts receivables and accounts payables, and salary payables, paying their employees. So actually, let's look for some more trends. So, like I said, access and manage your books from your computer. Manage everything right from the cloud, from the cloud, right from your mobile phone. Then automation of accounting function, outsourcing, as I mentioned, integration of accounting with operations, transparency and objectivity, data analysis, social media integration, changes in accounting standards, proactive accounting, mobile accountants. So let's see what they're saying. Cloud-based accounting. Cloud-based accounting allows providers to access financial information in the cloud. Automation of accounting functions. Latest accounting software has enabled organizations to minimize data entry, leading to efficient utilization of capital and better management of resources. Outsourcing, as I mentioned, to outsource an entire third-party provider, outsourcing to an entire, in other words, if you're outsourcing to an entire third-party provider, and they provide end-to-end support of the accounting function and customized accounting software solution and corporate controller level resources. So in other words, you're outsourcing to a third party, and they doing the entire they're doing the entire I guess your entire books, all your accounting books. You're outsourcing to a whole new company, not within your organization, but outside. As I said, outside, outsourcing to an entire third party provider. So an entire third party provider. So an entire third party providers. So in other words, sometimes if the books, if the county, if you don't have nobody that's working for you that can really, I guess what I would say this, that could probably handle their job. Sometimes you might, you're working for a company, you might be the owner of that company, you don't have nobody within your company that can handle this big accounting job, then you outsource to a professional company that can do your books, somebody that's, maybe have more experience. Sometimes you have accountants with more experience than other accountants, and they can handle the books. They know, like me, I just took a few accounting courses, so I couldn't handle no entire company, but I do want to keep on studying and keep on learning, and so I know enough of the basics to do some basic accounting. So like I said, this is cloud-based technology, automation. So in other words, like I said, mobile, right from your iPhone. Well, from a lot of companies probably already started that. That has been a trend. That has been a trend for a while. Companies, doing business right from their iPhone, whatever, or Android phone, iPhone, whatever phone you have, whatever mobile phone you have. Automation of accounting function, latest accounting software has enabled organizations to minimize data entry, leading to efficient utilization of capital and better management of resources. So automation means simply cutting out some humans, cutting out humans for certain job titles. And so automation is slowly coming into view, I would say, I guess, slowly coming in, not totally taking over, because we still need the humans to push those buttons, because without us, without the humans, I mean, it's just like this computer here. If I'm not here to push these buttons, it's not going on, it's not even going to take this wouldn't even be able to do this video without me pushing the button. So we are definitely still going to need the humans to some extent. So automation cannot totally take over. So there's no way in the world that automation can totally take over. Like I said, outsourcing to a third party, automation, outsourcing cloud-based technology. So that's the first three: cloud-based technology, automation, outsourcing. Outsourcing gives companies, so that's three. Outsourcing gives companies access to experience, like I said, and qualified accountants, and it shows a quality of service that is scalable and consistent. So when you outsource to another company so they can do your accounting books, it's going to be a company, you definitely want a company that is qualified, highly experienced accountant. You want to make sure they are highly experienced and qualified accountants. And it shows the quality of service that is scalable and consistent, because when it comes to accounting, you want accurate books. You're not going to hire no accountant. You're not going to hire an accountant that's fresh out of college. You might want to give them a chance and train them, fresh out of college. But a lot of times, when it comes to your books and your money, you might want a more experienced accountant, say for instance somebody maybe with about five years experience or something like that, 3 years experience. So I mean, sometimes some companies will give college grads um, an opportunity. I wish I had gotten more opportunities when I first came out of college, because a lot of times you need that training when you come out. You need to be able to come aboard a company and they train you, right out of college. But a lot of times, some companies don't want to train. But if you're coming out of college, you can find a company that would train you, and that's the best way to learn. That's the best way to learn the company, and how they do things. Um, you be integrated into the culture of their company, because when they training you, once they start training you, then you'll be learning how they do things, how the employees treat each other. You'll learn all the different operations of the business. So accounting functions can be regularly updated in real time by the sales department as sales occur. The integration saves time by automating routine activities. And then we have transparency and objectivity. Restoring trust and credibility of the accounting profession is essential. So restoring trust and credibility of the accounting profession is essential. So accountants there's rules they have to follow when they're doing, their income statements, balance sheets, statement of owner's equity. So they have to follow the generally accepted accounting principles. So they have to make sure they follow those rules. GAAP, and then you have data analysis. Information is the key to making financial decisions. So like I said, those information systems. So accounting, we have accounting. Accounting is that information system that I guess I would say builds those transactions. It keeps record. It keeps a record. It keeps a track of too at the same time. There's so many words you can put in there for a definition of accounting. It keeps track of those transactions that you have, like in the beginning of the accounting cycle. So accounting is that information system, just like any other company. You got a business company, you got a law firm, you got you have a company, you have McDonald's, Wendy's, any of them companies, and also you have whatever you have a landscaping business, whatever company you have, you have to gather that information, because that is the only way that you're going to be able to operate. That's the only way that you're going to be able to succeed and advance in your business. Information is important. You have to keep up with the trends in the market. Say for instance, you're a technology company. If you are a technology company, you definitely want to keep up with all the technology trends in the market. So that way you can operate your business better, more efficiently and effectively. If you're not up with the trends in the market, what can you do? What if you're running a company and you don't even have a fax machine? You don't have a fax machine, or you can't send out, and you don't have a computer. You don't have a basic computer, so you have to keep up with all the trends in the market. You might not have to have the most expensive computer system, but if you want to, you could. If you could, if your company can afford it, because you might want to, a lot of companies, they have, an email list. It's all about how you want marketing, advertising, and promoting. How you gonna get your business products out to your customer? Where is your target market? How are you going to reach your target market? And at the same time, is your target market willing to purchase? So all those things. So information is very important. You gather the whole email list of all your customers, all your prospective customers. So that's all part of information. That's part of your information system that you're building in your accounting firm. Or it doesn't have to be an accounting firm, but whatever business running. You might have a county department. You might and you might not. Like I said, you might outsource, but that information, gathering that information is very important. So gathering the information, gathering it right, make sure it's accurate. Um, then you have social media integration. That's another trend. Social media integration. So the first trend we had was cloud-based technology. Then we have automation of accounting functions. Then we have outsourcing. That's 3. And then we have integration of accounting operations. Integration of accounting operations. Then we have transparency and objectivity, restoring trust and credibility of the accounting profession. That's very essential. Information. Then we have data analysis. Information is the key to making financial decisions. Information generated by accounting has always been a crucial component of business decision making. Focus on data analysis of the underlying accounting and financial information is becoming one of the key accounting trends in 2020. Social media integration. Social media is becoming more popular. So everybody now is on. Well, we've been on Facebook, Instagram, YouTube, Twitter. Now they came out with the other app, TikTok. So even you can even set up a TikTok account, and they have a TikTok account for business. So I have my business on TikTok as well. So you can do your little videos on TikTok, and so it's so many ways that you can market, advertise, and promote your business, and it don't even cost you nothing. So it says social media integration. So I have my YouTube channel. I have my Instagram. I have an Instagram account where I have all my business. My business is on Instagram too. All my business products. My business videos. I even have some clips of my YouTube channel. Have a show on my Instagram page. Social media integration. Social media is becoming more popular for accounting professionals. They can communicate with their peers and colleagues to updates on latest business, political, and accounting developments that may impact their work. So they go on social media and interact with their peers, interact with their coworkers. You know, you're an accountant, interacting on social media. I mean, everybody else is doing it. So now it's just like I guess you could call it your social media workstation. It's like a workstation. You're right there on social media and interacting with your peers, your coworkers, whoever's in your company that you need to interact with. And it said changes in accounting standards. Accounting professionals, they need to keep up with the changes that are happening at a much faster pace now. So there's a lot of changes happening in accounting. You know, you can go to Excel also, and do your accounting books. You know, a lot of accountants have, we have the little we have like a little workbook. You have a little workbook that you could, you do your little workbook. You put your little, or your trial balance. Before you do your permanent books, make yourself a trial balance. So before you do your permanent books, you make yourself a little trial balance of all the accounts that you're working on in your company. Your accounts, and then you're going to have your debits and your credits. So in other words, we have a cash account, we have a land account, we might have a building, cash, land, buildings, supplies. And then, say for instance, your cash, you're invested in a business, your business started out with cash with $50,000. Excuse me. So cash, $50,000, debit. And then you might have land. Land could be $50,000. Worth $50,000. You might have your building worth a certain amount, supplies. The idea is check your debits and your credits and make sure they equal. Say say for instance, we might have 70,000 on both sides. So making sure your debits and credits equal. So this is just like a trial balance. So basically, you want to balance your debits and credits before you actually put them in your your permanent accounting records, I guess. So I guess, like I said, your accounting department will handle that. So, do your trial balance, or if you got a worksheet, you're an accountant, have a, worksheet. That way, as you go along, that's what accountants do. They have a worksheet. So as they go along, they're recording their information. So like I said, accounting is just information system. So it's like any other company. You are steadily recording information, jotting down your notes, and then at the beginning of the accounting cycle, you start out with a certain amount of money. At the end of the accounting cycle, after you add up all your revenues, expenses, accounts payables, accounts receivables, whatever accountants. I've never been an accountant, but I assume that those are the things that they will be, adding up. Accounts receivables, accounts payables, what's in your cash account, what's your net income at the end of the accounting cycle, balance sheets. Your balance sheet is the assets equals liabilities plus owner's equity, and that is the initial accounting equation. Assets equals liabilities plus owner's equity. So that's the initial accounting equation. So let's see what we have next. So those were the trends that I just read off, and I think that was it. Yeah, and it said accountants can work remotely, and there are currently many team sharing tools to enhance remote collaborative work. So in other words, with this COVID-19 anyway, a lot of companies are working remotely, so they said accountants can work remotely. So you don't have to work from your usual. So you're working off site, remotely. You're working from another location. Just like sometimes your computer systems, you have your central processing unit. You have a central processing unit may be in a different location, so you also can work remotely. Say, for instance, I'm working from home. I work from home where I'm doing, I work from home. These are my business cards. I design my business cards and everything from home. I design my oils. These are my oils for my hair growth oil for men. And one of my ingredients is coconut oil. So I have a whole lot of oils and stuff that I do use. So I design a lot of things at home. And these are the empty jars. And also, I'll get into a little bit of this later on. I'll be talking about this next. These are some of my other products, and then all part of branding. So these are my new company boxes, and I'll talk about this. I'll get into that shortly. But so that was that. Let's see. I think that was it. Okay, that was it. That was just the trends in accounting that I had did some research on. Okay. Let's do a couple. I want to just do a couple. Let's do a couple transactions. I'm gonna do a couple transactions real quick. Okay, the first one is sell in cash. Or selling cash to a customer. Okay, first, I'm going to talk about something just real quick. Okay, first of all, when you started out learning accounting, you'll learn this basic, this is an initial accounting equation. Assets equals liabilities plus owner's equity. Assets equals liabilities plus owner's equity. And let me see if I can write that bigger. Assets equals liabilities plus owner's equity. I just put OE. First you learn about that. This is how I learned it. When I first started accounting, I learned this. Assets equals liabilities plus owner's equity. I learned that. And then we learned, I learned different terms, like we had to learn what was revenue. What was a revenue account? What about the expenses? Expense account. And then we learned about accounts receivable, accounts payable, and also we have a land account, office supplies. We have a cash account, and we also have a depreciation account. Depreciation expense, accumulated depreciation. So what I learned was, first of all, we learned the initial accounting equation, assets equals liabilities plus owner's equity. And then I learned various terms, and then we moved on to the T account. In other words, learned about the revenue account or expense account. So in other words, your expenses, you have your electric, you might have your gas, your rent. So that will come under your expense account. Or in other words, one I left out was your liabilities account. The liabilities account probably would usually be your accounts payable, all your payables, your salaries payable, you have to pay your employees. That would be a liability account. So we have liabilities, which would be accounts payable, salaries payable, we have to pay employees. Accounts payable. If you want credit, you go to a store and you don't want to purchase, you don't pay for whatever you want to order or purchase. You can order it or you want to purchase it. You don't want to pay for that all at one time. So you want to create an accounts payable. You say, look, I pay for it in 30 days. So a lot of times you have to have credit. Like McDonald's, what if they go to another company? Sometimes you go to other companies. So what if McDonald's go to another company and they say, well, they might have somebody that they usually buy the hamburger buns from. The hamburger buns, the cheese, the ketchup, their hamburgers, their buns, whatever they need for the hamburgers, the onions. So they build up credit. As they go along, they build up their credit. And they may say, hey, I want 100,000 burgers. Can you send me 100,000 burgers? I want to create accounts payable. I want to credit accounts payable for how much it costs. In other words, you got 100,000 burgers. I mean, not the whole burgers, but the rolls. 100,000 rolls, 100,000 hamburgers, and then that will come under your accounts payable. So you want to credit accounts payable for whatever amount that would be, and then McDonald's will slowly, pay it off. But 9 times out of 10, McDonald's might not have to create no accounts payable, but I don't know. But I mean, I figure, they've been around for so long. So like I said, we have liabilities, assets equal liabilities plus owner's equity. So all this will come under information systems. All this information will be gathered at the beginning of the accounting cycle, and then at the end of the accounting cycle, that's how accountants will create their books. They create their reports, and then decision makers, accountants, when they finish their book, books, they're passed on to the decision makers. They're probably the company owners or the company managers. Those are the decision makers within the organization. So we have our revenues. We're going to learn about, keep this equation in mind. That's the first equation. This is the initial equation I learned when I first started taking accounting. So, make yourself familiar with different accounts. All your asset accounts, all your liabilities accounts. You have liabilities accounts and you have your asset accounts. See, these are separated. If I separate these, I would have asset accounts in here: land, office supplies, cash, and my revenue account would be my asset account. So, but we have revenues, expense accounts, accounts receivable, accounts payable, land, office supplies, cash, and depreciation. So, make yourself familiar with the initial equation, and then make yourself familiar with all the assets of your company or of any company, all your assets, and then all your liabilities. Your liabilities are your debt. Your liabilities are your debts, the people that you owe. Assets are anything that can be converted to cash that can be, that will give you future value. Say, for instance, your company purchased some land. Your company purchased some land for $100,000. 10 acres. $100,000. And then 5 years later, as long as the land is still going to depreciate a little, but if you keep that land up, and do what you have to do, it can be worth more 5 years later than it was when you first purchased it. So that's how that works. So what if you buy a house and you paid $200,000 for it, but you didn't do no work on it. And it just ran down. It ran down, and the kids ran it down in the ground, and ceiling caving in, and the floor messed up, and you didn't do no work for that house in 5 years. It's definitely going to depreciate in value, and not going to be worth what you paid for. You paid a couple $100,000 for it. But say if you buy a house for $200,000 and you put some work in it, you do some renovations. Oh, it's going to get you a pretty nice profit. It's going to get you a pretty nice profit. But if you buy something and you let it depreciate, and then it ain't going to be worth nothing. It ain't going to be worth, because you want, in other words, you buy a house, even if you buy a house or a car, whatever you purchase, land, buildings, whatever you purchase, you want to be able to make a profit when you sell it. So that's the idea. You want to be able to make a profit when you sell it. Okay, let's start out with the first one. Sell in cash to a customer. Let's go with sell in cash. Sell in cash to a customer. Sell in cash to a customer. Okay. I try to make it not so big, but I want to be able to see it on the board. So sell in cash. So I'm just going to do sell. In other words, let's make a sale to a customer. And we made a sale to a customer and we receive cash. So like I say, always, each account always affects, transaction. Each transaction always affects two accounts. So you made a sale to a customer. So 9 times out of 10, you brought in some cash. So you made a sale, say for instance, what did you sell? You sold 5 dresses. Oh, I sold 5 bottles of my hair growth oil. I sold 5 bottles of my hair growth oil for men. $20 a bottle. What's 20 times 5? That's $100. I sold 5 hair growth oils. I sold 5 hair oils. So, $100. I want to debit cash because cash is an asset account. Cash is an asset account, and I would debit on the left for increase. So I'm bringing money into my company, Shirley Cosmetics. So I'm bringing money into my company, Shirley Cosmetics. So I'm bringing money into my company, Shirley Cosmetics. So if somebody purchase something, these boxes, I put my items in the box at the same time. Well, Shirley Cosmetics. And so I sold 5 bottles of that hair growth oil for men, $100 on the debit my cash account, the asset account. And then what would be my second account? Probably would I'll say inventory. I would say inventory or even owner's equity. I'm gonna go with owner's equity. I sold 5 hair growth oils for men on debit cash $100. On credit owner's equity $100. So that would be how I did that one. So I'm gonna move over these fast. I'm gonna move over through these quick. Okay, now another one is a sale on credit. Sale on credit to a customer. So I'm just going to read them out like this. Sale on credit to a customer. So I sold something on credit to a customer. Well, let's go with supplies. Let's go with office supplies. I sold some office supplies to a customer on credit. Say, for instance, I sold some of my, this is black castor oil. Say, for instance, I sold some of my black castor oil. And also I have lip glosses. I have, lip glosses that I make in my company as well. So, lip glosses. And so, say for instance, I sold some supplies on credit. Our price for on this account, account payable. So supplies. So if I sold some supplies, that means I got rid of some supplies. I would credit my supplies account. So just say $500. I sold $500 worth of supplies. I want to credit my supplies account because I'm getting rid of some supplies. I'm decreasing. Now, if I wanted to increase my supplies account, since supplies is an asset, like I said my previous transaction, cash is a asset account. I debit on the left for increase, so I do the same thing for my supplies account. I debit on the left for increase, credit on the right for decrease. But since I'm decreasing my supplies account, I'm selling some supplies, I want to credit my supplies account $500. So that means credit. And then they purchase it on accounts payable. So I want to credit accounts payable $500. And let's see, we have the next one. We have purchase a fixed asset from a supplier. Purchase a fixed asset from a supplier. So if it's a fixed asset, I would say it's still an asset. It don't say which. This is just something that was out the book, came out the book. So it said purchase a fixed asset from a supplier. I mean, a fixed asset. Let's go with land. Well, if somebody purchased land from you, I don't want to debit my land account. I probably want to credit my land account because, let's see, land is an asset account. Now, if I wanted to increase my land account, just like I did my cash, I just did a previous account, asset account, cash, and then I just did office supplies. So I debit on the left for increase, but since I'm selling some land, I'm gonna credit on the right. So it said purchase fixed assets from a supplier. So if you purchase, well, you know what? If you purchase it, then I would debit on the left. It said purchase purchase fixed asset. So if I purchase a fixed asset from a supplier, but it don't say how, it doesn't say whether it's accounts payable or was it cash. It just say purchase fixed asset. Purchase a fixed asset from a supplier. So a fixed asset could be, I could say anything like land, building, inventory, cash. So I'm gonna go with land. I purchased a fixed asset. Let's say I purchased a fixed asset for $100,000. So I want to debit my land account. I want to debit my land account for $100,000, but it said purchase a fixed asset from a supplier. Now, if I purchased a fixed asset, okay, you know what? If I purchased it, I had to pay for it. So I had to think now. I had to be on my P's and Q's. So $100,000. I purchased some land for $100,000. I had to pay for it. So I'm gonna have that come out of my cash account. It could also, it's kind of tricky because it could come out of my cash or it could come out of owner's equity as well. So $100,000. Then also you have a withdrawals account. So, but I don't think that a company will want to withdraw $100,000 out of their withdrawals account. So I'm gonna go with cash. I want to take it out of the cash account. So I want to credit cash. See, it always the debit's on the left, credit's on the right. So coming out the cash account, cash is an asset account. I want to credit on the right for decrease. So that's that one. And let's see. Okay, let's see. Let's go with, let's see where we at. I actually do a couple more. Purchase consumable supplies from a supplier. Like I say, always one transaction affects two accounts. Purchase consumable. Just as like a consumable means a consumer. I guess consumables mean items that you purchase that you can use up. In other words, you buy a case of water. You will consume that water because eventually you're going to drink that water up. So, you know, that water, your juice, milk or whatever. So that those would be considered, I guess, consumable supplies. Even probably typing paper because I guess you're going to write on it. But I guess I would go with like milk and juice and different things like that. Consumable, something that you would use up in a certain period of time. So purchase consumable supplies from a supplier. Let's go with let's go with typing paper. Let's go with printer paper. If I purchase it from a supplier, I'm gonna have to pay for it. So I'm going to go with cash and supplies. LIES. Those are the only two I can think of. So let's go with so if you purchase some supplies, then you are gaining an asset. So say for instance let's say we paid $1,000 for these supplies. I'm going to debit my supplies account because I purchased some supplies and I'm gaining an asset. So I want to, since supplies is an asset account, I'm going to debit on the left, just like I did my cash account and my inventory account and my office supplies account. Debit on the left for an increase. Even the land account, if you purchase some land, that's an asset account. You want to debit on the left. If you purchase that land, you debit on the left. But if you're getting rid of land, you want to credit on the right. Okay, so cash. So in other words, purchase some consumable supplies from a supplier. So if I purchase some supplies for $1,000, I'm gonna credit on the right. In my cash account, this is debit, this is credit. So my cash account, I'm gonna credit on the right for $1,000. Because I'm decreasing my cash account. I'm taking $1,000 off my cash account, purchase my supplies. So that's how that will go. So a lot of times I usually do mine. I like doing my T accounts separate because I understand them better. But sometimes you can just have one T account and you can just go all the way down. Okay, let's see. Here goes one right here. Investment in another business. One transaction affects two accounts. So it's a cash investment in another business. Say, for instance, you want to invest in another business, but you got a cash investment. That means you're going to have to take some cash out of your business to invest in this other business. So cash investment in another business. So I'm going with cash and owner's equity. So I will have to take it out of my cash account. I'm going to credit cash, depending on how much I want to invest. Say for instance, I want to invest $200,000. I want to invest $200,000 into this other business. And I hope that I'm hoping that is a good decision. See, if I want to invest in another business, I definitely have to make sure that I am well aware of how good that company is doing. So how well is that company doing? They're not on the verge of bankruptcy, are they? So that's what I want to make sure. But I want to invest in another business, say, like I said, $200,000. I'll have to take $200,000 out of my cash account. I'm going to credit my cash account. And since it's coming out of my owner's equity, I want to debit owner's equity. I don't want to credit owner's equity. I want to debit owner's equity. $200,000. I want to debit owner's equity. $200,000. I want to debit owner's equity. $200,000. Credit cash. $200,000 because it's coming out of the cash account. So credit cash. $200,000 for a decrease. And I want to debit owner's equity for decrease. Let me see. I think I got this last one. Okay, I don't have. It doesn't. I don't see. Okay, I can make this one up. It says okay, it's accounts payable in cash. So let me see. Okay, I need to buy some supplies for Shirley Cosmetics. But I want to purchase some supplies on account. Accounts payable. Say for instance, I need my packaging. I need my packaging. I have to I need my packaging. I have to I need my packaging. I need my boxes so I can mail send to my customers. I need this is beeswax. I need my beeswax. I need my beeswax. I need my shea butter. I need my mango butter. Also, I need tablets right here. I need these. I had these made through Vistaprint, so I want to box of these too, see? So I need, these are all supplies. So when I order these, if I have enough of these, when my customers order, then I'll have them. So, yeah, so when my customers order, I'll have them. So, like I said, my customers order, then I'll have them. And also, jars, labels. labels, jobs, logos, all these things have to be paid for. Yeah, all these things have to be paid for. So, like I said, this is the last one. So in other words, all the supplies I just showed you, I need to purchase those. I want to purchase them on account. I don't want to pay for it all at one time. So, my shop. So, I need some supplies. Say for instance, I need $1 million worth of supplies. But since I need to purchase some supplies, I can debit on the left because supplies is an asset account. So like I said, debit on the left for increases. Like I just did with my cash account, my land account, my office supplies. When I'm purchasing those items, I'm bringing them into my company, I'm creating an asset for my company. So I want to debit on the left for increase. So I said $1 million. I want $1 million worth of supplies. I want to debit my supplies account for increase. And then, but I don't want to pay for it all at one time. So what I want to do, I want to create an accounts payable. I want to create accounts payable for $1 million. Supplies, 1 million, debit, 1 million on the left side for supplies, which is, all the supplies I need. I just showed you my logos, my labels, my jobs, my company boxes, all this part of branding, all my pictures, all that, and everything I need, included in my supplies account. And then accounts payable. I want to credit my accounts payable account $1 million because I'm not paying for it all at one time. Now, I created notes payable. If they write it out as a promissory note, if they write it down as a promissory note, and I sign it, telling them that I promise to pay, it still be the same thing. Promissory note, $1 million. So the promissory note. So they call that note payable. Accounts payable, notes payable. So notes payable, when it's written down, they write it out as a promissory note. You promise to pay. Just like when you get your student loans. So when we got our student loans, we had to sign a promissory note. You don't think about them things until after school is over and it's time to pay their loans back. But when you think about it, you say, oh yeah, I did sign a promissory note. Yeah, I learned about that in accounting. Because at the time when you're signing those promissory notes, you're not really paying attention. Sometimes you're not paying attention. So a promissory note is just a promise to pay. So we have a like I said, note payable, and accounts payable. Also, you have accounts receivable and note receivable too. EIVABLE. Accounts receivable. You have note payable, accounts payable. So like I said, note payables when it's written down as a promissory note and you promise to pay. And then accounts payable, notes payable written down in a promissory note. We have accounts receivable and notes receivable. So once it's written down as a promissory note, promissory note, written down as a promissory note, will be a notes receivable and notes payable. So I think I want to, let's see, let me go over just a few things, okay? I think that's the last one for just want to review a little accounting. So, just want to go over a few little things. Just a few little things. I already showed the business items, but little hand sanitizer because I've been dealing with that chalk. So hand sanitizer. Okay, so I want to end it on that note, but just want to show a few little things. So just talking about business. So when you're dealing in the business, so like I said, accounting, if you run a business, you might have a accounting department or you might outsource. But me, I'm just starting off small, so I don't have to worry about an accounting department because I know enough accounting to do my books because I'm just small. I'm a small I just have a small business venture, so I don't need no accounting department. I don't need to outsource none of that right now. But I think I know enough accounting to do my own accounts receivables, accounts payables, deal with my cash account, my revenue account, whatever accounts I have, So I'm a small business, so I don't need to do all that. But when I started out with my little business venture, I started out first with a business name, my niche, what kind of products I want to sell. And then I had my business cards made up. And I designed them myself with Vistaprint. Designed them myself and let Vistaprint print them out. And I also had my little thank you cards made up. I designed these myself. Because what I do, I save my pictures on my computer. And then I just upload them to my card, design my card how I want it. And so when I design my card how I want it, and then Vistaprint print them out. So then I deal with Avery at the same time. So I deal with Avery, and then I design my labels for my oil for men. See the little logo? You put your logo on there. I design it. Shirley Cosmetics. Grow Your Hair Man, hair growth oil for men. And these are the ingredients at the bottom. We have organic black castor oil. We have vitamin E. Then we have some essential oils. We have coconut oil, sweet almond oil, chamomile essential oil, and watercress. So these are, sometimes later on I might switch over. But for right now, these are going to be my labels. And then I have my balm. This is Kenneth Walker. Kenneth Senior Boss Man Hair Growth Balm for Men. So my logo, my picture, these are my labels. And these and then when I mix it, I put it in the refrigerator for about 30 minutes and then let it take like a balm after I mix all my ingredients. So, and like I said, some of my ingredients is I use unrefined shea butter, and then I also use raw mango butter. And I also have a coconut oil that I do use. Different oils I use, depending on what the ingredient called for. And this is jojoba oil. That's jojoba oil. Black castor oil. Then we have some rapeseed oil. I like to use all natural oils for my products. And this is castor oil. Castor oil, 100%, say 100% castor oil. And 100% castor oil. And also vitamin E. And vitamin E oil. And then also these two new oils that I ran across. I'll be doing more research, man. Because see, my niche is, this is chamomile. My niche is hair growth, so I'm constantly doing research. And this is a watercress seed oil. If I can hold it steady. If I can hold it steady, watercress. And then I have, then I also have, jojoba. I already showed that, I believe I did. Jojoba. And then I have, this is, avocado oil. 100% avocado. See, avocado. And then I have, almond oil. Almond oil. And then I have something I made for my children's line. It's Avi hair growth balm for children. I like the brand with my picture on it. And this is something I made for the men for your beard. So this is what I make for the beard. This is a sample. Cleanse moisturizer beard balm for men. And smells divine. This is just a, sample. Smell divinely. And I have also I have something for the ladies called Grow Your Hair Girl. Excuse me. So like I said, I have a Grow Your Hair Girl for ladies. Grow Your Hair Girl for the ladies, and then for the men, I do have these are all the ingredients at the bottom. So, yeah, so this is a Grow Your Hair Girl. So what I do, Grow Your Hair Girl, just take a little bit. And I always, put it on your edges. And keep your edges growing. So, this is just a fake ponytail, but this is my natural hair right here. So sometimes you put it right there in your part. Put it up here where your hair is thinning. And use it for a while. All my edges. And so, there you go. So, I want to say thanks for joining me today. And so, like I said, these are the items that I do be making. And up here, you put some on it. All up here on the edges, too. So, and then, see what I do. I use some of my confetti paper. And then inside my tissue paper. Inside. And then if somebody, you know, order something, it'll go like this. I have all my, and then my jars. And I want to say thanks for joining me today. Glad you could be here. Glad to see you. And these are my new boxes that I just received. So I want to say thanks for joining me today. Glad to see you. Glad you could join me. So these are, and I probably will be sending out some samples to some of my family members and let them just, you know, sample. So this is my confetti. So I just put this down inside my boxes. But I want to say thanks for joining me today. And glad you could be here. Glad to see you. Glad you can join me. I said I went over an hour. And I want to say thanks for joining me. And I'll see you on my next video. I'll see you on my next video. Now I have to think about what I want to think about what what I want to cover on my next video. So branding, marketing, advertising, promoting. Get your products out there to your target market. Instagram, Facebook, Twitter, YouTube. Get your products out there to your target market. Email marketing. Send out your, create your email list. Create your email list. So then keep your customers and your potential customers abreast of what products, new products coming in your product line. You introducing new products in your product line. You send out emails. Make sure you create your email list. You send out emails and let them know. Say, hey, I have a new product color. I have a new product item that I'm about to drop. You're the first one I notified. So email marketing, Twitter, Facebook, YouTube, Instagram, and like I say now, businesses are coming on TikTok now. Go to TikTok. It's so fun. I be on there every day. Every day I'm on TikTok, just looking at different, different businesses, different people, what everybody doing, on there. And I have my little business videos on there, so I will be putting some more videos on TikTok. But until my next video, hope you enjoyed this video. So comment below, subscribe below, and also I'm taking donations. I have my I'll put the information below. Venmo or what you call Cash App. I'll put the information below, so that will help me, create more videos. I have to pay for my internet. I have to pay for my electric. I have to pay for my logos, my labels. I have to pay for, different things that I need to keep my business running, to keep my channel going. So donations, I don't care if it's $1, $2, $3, But thanks for joining me. Glad you could be here. Glad to see you. And I hope to see you on my next video. Like I said, comment below, subscribe below. And I'll see you on my next video. You all have a good one.